Good day, traders. The 4-step method to high performance trading is a free course download for increasing your confidence in your ability to execute your trading edge in live time. The link for the download is in the description box below. And the free audio program, the 7-step daily routine for high performance traders, is also a free download to develop your discipline, your confidence, and a winning mindset to master the markets. Again, the download for these links is in the description box. They're both free downloads. Let's get started.
Good day, traders. Stacey Burke from Stacey Burke Trading. Today we are going to be going over 3-session setups. We'll also review the weekly templates, the 3-day templates, but we'll specifically hone in on the 3-session setups. We're going to talk about some different concepts today to reinforce crystallizing and identifying the best candidates for the best trade setups. It doesn't matter what session you're trading. You could be trading the Asian session, you could be trading the London session, or you could be trading the New York session. The same rules will apply, and depending on the instrument selection that you have in your basket, you should be able to have guaranteed. Now, it doesn't really matter what session you're trading, whether it's Asia, London, or New York. These same rules will apply. We're still going to be looking for, number one, 3 levels of rise or fall. Typically in the currencies, that will be 75 pips or 3 boxes, as I talked about in the other videos, 3 25 pip boxes. They may not necessarily be 75 pips from high to low, but they will stretch out across 3 boxes, a lower box, a middle box, and an upper box. Typically, gold can fall into this category, but on a larger range, as the range expands, gold may go out to 3 levels of 50, as may oil and indexes. And indexes can also go out to 3 levels of 100. And again, it's from top to bottom. It may not be 300, but will be in 3 levels of rise or fall in terms of penetrating into an upper and a lower 300 pip box, 100, 100, and 100. And that can be coming back to levels, moving away from a high of day or moving away from a high of a week, or through a high of day or high of week if it's a 3rd level, or again moving away from a low of day, so 3 levels of rise away from the low of day, and we'll talk about that in one moment, or away from the high of the day, back inside. And then we're looking to be able to identify the peak formation highs and peak formation lows. Now, I received some questions regarding this and comments, and I've reviewed this several times, but I'll reinforce this. The peak formation high and low should be created within a session. So the US session may put in a peak formation low. London the next day may put in a peak formation high, meaning that Asia trades inside. So you have perhaps a 75 pip box, US session peak formation low, London peak formation high. They may go back up into the peak formation high in consolidation for a vertical move down. Again, we'll review this on the charts. So peak formation high, peak formation low, and consolidation. So ideally, we want to see some sort of remnants of a pattern of a peak formation high, a peak formation low, and we may see the consolidation down low for a vertical move back up. Contrary to that, we may see a peak formation low and a peak formation rise, and the market working back up into the high before making a vertical move back down to the low. This could be session 1, this could be session 2, and heading into session 3. In some cases, we may see a peak formation high, a peak formation low, and 3 levels of rise up into that peak formation for a vertical move back down. And the same thing applies for the opposite. We could see a peak formation high, a peak formation low, and a market that breaks back down before going vertical. Or a peak formation low, peak formation high, and a creeping trend back down into the low for the explosive reversal trade back up through the high of the day. There are lots of different variations. We're going to look at some subtle differences, and we'll look at today's charts on a Monday, the opening range of a week. Monday typically can be a narrow range type of day, but also we'll look at the templates, the weekly templates, and coming back to the 3 things that we want to be focused on. Now, there are 3 main types of templates that I'm always focused on within the 3-session setups. and that's the 3-day setups. We're talking about the opportunity for large parabolic opportunities that build up over 3 days. So we will be targeting 3-day setups, which will begin with a failed breakout at the high or low of the week. And that begins our day count. So the failed breakout at the high or low of a week begins our day count for a 3-day setup. Then we have 3 days of breakout traders in the markets. So each time a breakout, once the breakout level is broken, for example, we have a market that's been going down and we get breakout traders in the market long and they close out of balance. That's day one breakout traders in the market. And I refer to that as D1, D2, and D3. Now, some people find that confusing. Call it whatever you want. The whole idea is to understand when breakout traders are in the market. We want to know when there's been 3 days of breakout in the market, because that is when a market, if it is set up properly, has the potential to offer us an asymmetrical 90-10 best trade setup candidate. So again, it's 3 days where breakouts have been in the market, so we can get a market that breaks a new level 3 days in a row, or an inside day and another third day, or we can have 3 days of breakout traders in the markets, which is different from the other types of setups. Then we have our Monday to Friday, day 1, day 2, day 3, and Wednesday resets as our day 1, heading into the closing range of the week, day 1, day 2, day 3. And our closing range, opening range and closing range. So this is how I view the market now. You can choose to look at it however you want. I'm giving you the information that I use to identify the best candidates in the US session and the Asian session when we go front side, back side. If we have a day 2 opportunity for a parabolic move on the front side, perhaps on a Tuesday or a Wednesday, or a day 3 on a Wednesday, or the same opportunity on a Wednesday, Thursday, Friday on the back side of a move, or a continuation. So understanding that Wednesday is the midpoint of our week, Monday, Wednesday, Friday. If you go back and study your charts, remember I'm not looking to try and trade a market every day. I'm looking for the best setup over a basket of instruments that give me the highest possibility opportunity on the day based on the day count and the 3-session setup heading into my US session window. So I want you to think for a moment about how money is really made in terms of the setups and how you're going to be able to scale those types of setups up in size. So remember, my objective is to identify parabolic opportunities. Parabolic opportunities are when a market either pumps and consolidates for a dump, for a vertical move, or it dumps and consolidates for a parabolic long trade, a dump and pump move. And so I'm giving you some homework in terms of understanding when markets coil for explosive moves. That's what I really want to hammer home to you, is how they set up and how they coil for an explosive move. Not about getting a direction right. I want to know where the coil is, because that's where size can be put into the market, because a market is about to explode. So in terms of zero stress, zero emotion trading opportunities, these are the types of opportunities that build up in these 3-day setups, these day 3 breakout opportunities, and Monday to Wednesday, Wednesday to Friday, 3-day session setups, three-day opportunities with 3-session setups. With red news in the calendar, same rules apply. We'll talk about that briefly as well, the 4 types of situations with news, but really understanding that these opportunities are there almost every single day. With regard to major red news, we have news on the calendar often, and so my thesis is that I never trade before a news release. So I never trade right before the news or am in the market. So if I'm in an existing trade, I'm out of the market before the news is released, and I am not in the market when news is released. So what that means is that if I have an existing thesis, for example, we have first bounce opportunity, which we'll talk about. I'm waiting for that thesis to be confirmed by the news release, so I can have a bigger time frame setup, 5-minute, 15-minute, hourly. It's all the same if you're working from the high and the low of the day. the time frame setup is the same. It's irrelevant because you have a high and a low and a consolidation. But I can't get into the market without putting significant risk on myself if I want to be trading any type of size. So I know a lot of traders get in before the news and they trade setups, but I realistically don't. For myself, that's not realistic because you can't put a certain size in the market and risk 50, 75, maybe 100 pips of heat against your position because they will put slippage into the market. What you see on the chart when the news is released with a large wick may still have a 50 pip spread on top or below those wicks where they pull the offers and lift the bids, but it will execute you. If your stop is 25 pips, you might get a 75 pip stop out. And so if you're trading size and all of a sudden you're just stopped out instantly, and then you look at the loss that you've just incurred, it's well beyond what you thought you were managing as your risk. So needless to say, I never trade before the news, and I'm not in the market when news is released. So first bounce, there's 4 types of major news release candles in that first minute of when the news is released. This is understanding when that first minute happens after the news is released. I want to know what type of, number one, before the market releases that news, what type of setup do I think that I have over the bigger picture, the bigger template. When that first minute is released, there's typically 4 types of 1-minute candles that I will see when I'm looking at an opportunity. The first bounce opportunity is an explosive breakout that will give us an opportunity to re-enter that explosion because it's a news momentum catalyst. And that breakout pullback continuation is the first bounce entry into that explosive movement after the news is released. We can see that sometimes on payrolls, maybe CPI, and sometimes that breakout pullback continuation will also coincide with a longer time frame, 5-minute, and sometimes in some rare instances a 15-minute chart. But that first bounce opportunity allows us to participate and get into a high momentum opportunity. Gold is a very, very good candidate if you've mastered gold or if you've studied it long enough and been trading it. It gives fantastic first bounce opportunities when the longer time frame setup is there. And so we may have a setup over a longer time frame, maybe 2 or 3 days. And we may have an opportunity where the news is about to be released and bang, the news is released. And we're like, wow, how we couldn't get into that, and some traders are, we're shorting it. But what happens is that on our smaller time frame, we will get a re-entry in for this market to give us a continuation opportunity when it coils and gives us the first bounce opportunity. First bar, on the other hand, shows up in some different situations, but typically I will look for this on a day 2. Day 2 is when we can get 3 levels of rise back into the existing move. So for example, if shorts were in the market, we had a day 1 breakout that's short, and the market the next day proceeds to work up in 3 levels and 3 sessions into the Asian session, a London session, and then we get one moment we get a news release candle, bang. And that market in the 1 minute traps all this volume. Might consolidate for 1 or 2 more minutes, but often that market then will close at a 5-minute close down at the bottom of the range. And traders say, well, how was I supposed to take that trade? It's a 20 pip candle, 25 pip candle, but it's a news momentum catalyst, and it's also a setup because this market now could potentially go on a range expansion, a high-low range expansion for a measured move. We can still manage our risk, and we can also look for the measured move as a potential profit target. Now, there are some other instances, and we can see this occasionally, where we'll see that first minute bang break down, and it may continue to work down into the low based on timing, levels, and the template, the overall template, for another 25 to 50 pips before reversing, and this first minute closed down here, and that market then will come back into traders because they've got the first minute entry trapped down low. So again, understanding when a market has moved, the behavior of price at the next level, knowing when to cut a trade and lock in profits, but also knowing when to look for a reversal and who is trapped. Now the other situation is number 3, where we can see a news candle that will usually typically start in the middle of a range, and it will wick one side, wick the other, and close back inside. And often one of those extremes will now be the level that the market will drag traders down into, and coinciding with a new hourly cycle starting, we can see the beginning of a reversal trade opportunity. Sometimes it could be down low on a day 3, low of a week. It may just be a session trade back to the high of the day or back to the low of the day, or we can see it up high on a day 3. Sometimes we will see this if we've had a large day 1 move on a Wednesday, for example, a pump, and then we may see the reversal on Thursday for the dump or the reversal case of that. But this will often be where we see wicks. We want to see one of these extremes traded back to, and that you will usually coincide with a new hour opportunity if the setup is there when it reaches that level. Timings, levels, behavior of price. The last situation is where we don't really see anything happen, and the market may be making higher highs. For example, it breaks out, pulls back. We want to see a breakout pullback continuation. We can't because we have major red news. The news is traded. Nothing really happens. We go back to our original thesis. It could be the second hour, New York Open, and the market continues in its original direction. The important part is, though, is that I never trade right before news or am in the market, because I could just get in thinking, oh, this is going to keep going up, and next thing you know, they throw a 50 pip wick in before coming back, and it will happen. I don't mess with the news. That's not part of my strategy. It's not necessary. There's no need to risk your own capital getting in front of the news. There's plenty of opportunities after the news. Now, I'll just have a brief run through of the currency pairs, then we'll look at the overall templates, but we'll just have a quick 1-minute run through each of the major pairs today, and I want to just hammer home some simple ideas. Number one, US Swiss franc. We have a market that broke out of a daily low of day and closed as a bullish day. Closed as a bullish day on Friday. Pink line is our Monday-Friday separator. Now let's just go back to what we talked about in that first slide. A peak formation high, US session. Peak formation low in our London session. This is on Friday. And then we have a market that went into consolidation in the upper part of the box as the new week started. Our new timing cycle, Monday starts, and the market starts to break down from the upper level. So if we just take this upper quarter, we can call this trap volume up top. We're in a currency pair, so obviously not the same volatility that we'll see on oil or gold or these indexes, but we have trap volume into the peak formation high. The market breaks down and is making lower lows and lower highs. That's the setup for the pump and dump. Pump and dump in our Europe-London window. So remember, peak formation low, peak formation high. The creeping trend that's fading down into the breakout low of day from our Friday session. So we have that reversal dropping down from the peak formation high. And then heading into our US window. So peak formation low, peak formation high, the creeping trend back down. And if we put our universal EMA on our chart, we have a vertical parabolic opportunity possibly heading into our US session. We had major red news on the calendar, which would have prevented traders from taking that opportunity. But after the news, 5 minutes after the news, that market continued its move up for 20 pips. Not saying this is the best trade candidate. I'm just pointing out the process and understanding high of day. That's our high of day going into our new day. We're dropping down 1 quarter, 2 quarters. It doesn't quite get there before consolidating and reversing heading into our US session. If we were to go to our 5-minute chart after the news, again, no major sort of explosion, no real wicks. Market breaks into the next level before pulling back. Second hour starts and allows traders to enter this trade with a 1-bar stop, managing our risk in an existing uptrend for a move back through the high of the day, the current day. Doesn't quite get there, but again, timing, levels, behavior, price. This is the New York Open at the high of the day. But if they were to follow this through back through the high of the day, that was an easy 20 pips roughly. The market would have filled in around 07 on a 5-minute chart. That market went up to 30-ish, and the high pin was up to 30. So again, 20 to 25, zero stress, zero heat peeps. Timing levels, behavior, price, they've broken the high of the day. The New York Open is happening. We're at the quarter level. I'd be cutting that trade and taking the money. So just backing this up and remembering peak formation low, peak formation high, consolidation. Not saying any of this is a best trade candidate, but you see the template. Peak formation low, peak formation high, consolidation, fade, parabolic, reversal. Now we're looking at the US Canadian dollar. Again, on Monday, we have a peak formation low that formed in the US session. That was our last low before an explosive short squeeze move back up through the high of the day. Peak formation low. We have 1, 2, 3 levels and a fourth level of rise. So we're above the double zero box. Simple thing to do is just draw my quarter level. We have a market that breaks the previous day's high, so we've come up 3 levels. We get lower lows and lower highs heading into our US session. Lower lows and lower highs on the inside is the setup for the pump and dump. So this clears everything out to the left. All I'm looking at now is this right here, pump and dump. The pump and dump scenario. Again, we pump it up, it breaks down and makes a lower low and a lower high inside. Pump, dump news for the collapse right after major red news. This is an example of where the news really did not react at all. We didn't see any real explosive moves. We see the market coil and break down at the end of the hour, so we had an opportunity to enter that at the end of the hour, the end of the first hour after major red news. We had an opportunity to add to that position after the New York Open. Again, I'd be looking for something as it's breaking down on the smaller time frame. But even so, we have an opportunity now for a range expansion coming in our reversal. So if we just back this up, we'll put a 15-minute chart on there for a moment. We've got our upper quarter is our rectangle. In simplicity, our upper quarter is our rectangle. We have an opportunity for that market to go at least 25 pips. And timing, levels, behavior, price as this market is slowing down into that first range expansion. 1 push, 2 push, 3 push. A good reason to be trailing this down as the market is falling and locking in profits. Traders have asked, how do you manage the trade? I never trail anything until it gets to a level or within 10 pips of a level in terms of my profit targets. Once it falls through, as I've mentioned, it should collapse through. So once it collapses through, I will follow it down. And then if it does reverse, it takes me out of the trade. So in this particular case, most likely we would have been taken out above this lower bear candle, because when it breaks that level, it's either going to capitulate or reverse if I'm not already out of that trade. But again, a simple pump and dump Friday, Monday opportunity. 3 levels of rise, lower lows, lower highs, the consolidation, major red news, end of hour opportunity, a New York Open continuation opportunity, and then locking in the money and getting off the screen. There was nothing on the British pound that I found of any interest whatsoever. There was no real example of any sort of pump or dump template. We have a market that trended strongly last week and continued to do a range expansion. And we had a low of the day broken, but we just see a market that's auctioning back and forth, and this is not what I would consider to be a best trade candidate setup on the day itself. Same thing with the euro. We're essentially in a trading range between a high and a low. The market did not really, as I've talked about, go parabolic or go vertical and consolidate. We've just got a market that's trading back and forth in a trading range with no real distinct levels of rise and consolidation. Again, just a low probability type of template. No interest to me whatsoever on the day. Now, gold was fantastic in terms of its predictability. It usually will set up, in most cases, 3 or 4 times a week in an ideal type of opportunity. We had first red day on Friday with our dump into the end of the day. So again, just looking at this chart, and just visualizing that we have had 3 levels of drop from the close of Friday. So we've made a lower peak formation high and we've come down from 0. 00, 75, 50, and 25 into level 1. So level 1, remember, is that 0, 00 to the quarter level, and I call that my level 1 area. And we had the previous day's low. So this market drops down and traps volume in that bottom half of the range before making higher highs, higher high in the Europe-London window for the dump and pump setup in the London session, going back up 3 levels of rise, back up into Friday night's peak formation short sellers up at 00 level. So again, the higher high on the inside, same as the pump and dump, the lower low on the inside, the dump and pump setup, and then the peak formation. So we have 3 levels of rise. We mark this off. All these trades who are long are sitting ducks if the market reverses. And the market, coming back to timings, levels, behavior of price. So some traders, again, wanted to sell it before the news, and I have no desire. This doesn't even, I'm not chasing anything. I have zero emotion attached to trying to get in early because I know that the opportunity will be there. And that is something that I'm quite happy to wait and be patient for. So the thesis was first red day, 3 levels of rise for a sell, but the market moved prior to major red news. The thesis is already in play. We have a market that has put 3 peaks into our peak formation high that was made in the gap time. We're already broken down. So I get asked this question quite a bit. What do you mean by a broken down market? The market is now on the backside and is breaking down and continuing to go lower. Our news candle is released and we get an engulfment coming off of our universal EMA. This is the 1 minute chart. And for traders who, again, if you're going to trade gold and you're going to trade around major red news, you don't have to use a smaller time frame, but again, timings, levels, behavior of price. And as I mentioned to some traders, the ideal opportunity would have been to get filled above 50, except that we had to wait for the news. And on the news release itself, it engulfed and then pinned on the 2nd minute. That pin is the opportunity for me to enter. That's the consolidation underneath the peak formation high. Now, if we'd gotten in early, they could have easily went bang, bang. We don't know what it's going to do, which is why we just wait, because there's no reason to have FOMO. There's no reason to get emotional. There's no reason to chase anything. Just sit and wait. The market will give us our opportunity, which it did. And now I have a thesis that I need to be filled above the quarter level and his best fill price, but we've already engulfed and pinned. Now I'm willing to trade this until we get underneath of this level, this little consolidation in that low, because it should collapse through, and I don't want to be adding in, but I will certainly add in that 3 minutes because I know that market is preparing to just fall through the floor. And if you've, again, traded gold enough, you know that this market will go through to a higher low level. So our thesis is the market should continue to move down. It did. It came down and went to the quarter level outside of the range, 25 to 50 pips outside of the 00s. And then our timing window, our new hour kicked in, so it was time to lock in profits at the end of the hour. And then the New York Open continued to go lower. Now, I had a potential possibility that we would maybe look to see a measured move of this range targeting 50 because of traders that were long in the market from Wednesday's U.S. session. So we have longs in the market from Wednesday's U.S. session. I thought there was a possibility they would trade back to that level. They didn't go all the way. They went down as low as 57. Still a second hour New York Open continuation for 35 pips of zero heat. 3 pushes into the low of the day. So I come back to understanding. I make this joke all the time. If you can count to 3 and you can tell time, you can make a lot of money. And people think I'm kidding, and I'm not kidding, because the new 15-minute cycle is about to start after the New York Open. We've gone down for 15 minutes and we're creeping down. So again, the process of locking in the money as this market breaks down, because it should either capitulate down or take me out of the trade. So I'm fairly aggressive once it breaks through a level, but happy to take off another 35 pips and just lock it in and get off the screen. So the first move was a very nice trade straight through for over 50 pips, zero heat, but we also had opportunities building on the indexes. Looking back at this chart, this is a template. This is a template. 3 levels of rise into the open of the session. 3 levels of rise, 3 sessions set up. Asia, London, and into the open of New York, coinciding with our peak formation high from the US session. We had a peak formation low in place that they auctioned down into. They went into consolidation down low in the lower half, lower third of the box before auctioning up 3 levels. This low right here, understand, so excellent question from a trader, is a few pips outside of the range, a false break. I talked about this earlier. No, but that lower low now, that lower low, that's the lowest point of the day. Lower low on the inside is the setup for the pump and dump. This is all, I don't need to worry about any of this to the left now. They've cleared all that out. They pump it up 3 levels, 3 pushes. They collapse before the news. It's a continuation low-hanging fruit trade after major red news for an easy 50 plus pips. A second hour New York Open continuation low-hanging fruit for 35 pips. No stress, zero heat. And that's the key things to understand. When these levels are broken, it's not looking necessarily that we're trying to trade off that level. That lower low is our reference point for the pump and the dump. This is a template, the same as the Japanese yen, the same. We often see this on a day 2. And if this is first red day and this market is going to collapse, today's low may also be a reference point for the beginning of a 3-session pump and dump if this market was to break down and collapse and retest that low of the day. We have day 1 shorts in the market. We're looking at the DJ30, and this is an excellent chart. We have a couple of things to observe on this on Friday, in that we had trap volume, a failed breakout down low, and then we also had a failed breakout up top that closed back inside of the breakout of Thursday's inside day trade on. So you'll notice we broke the levels down low. They trigger the inside day on Friday. They go vertical. So short inside bar traders stopped out, but then they go vertical into shorts from Wednesday's peak formation high, day 1, day 2, day 3 parabolic. The market broke out and the New York Open reversed. So we had a day 3 breakout. This was day 3 breakouts in the market on Friday for a perfect reversal opportunity. Now, one thing we didn't look at on the other charts, but we'll do it on this one, is the closing price. You can go back and check this. It was on pretty much every instrument, but Paul Tudor Jones talks about this, the importance of the closing price. So if we take Friday night's closing price and we come back to understanding the types of templates, dump and pumps, pump and dumps, 3-session opportunities. We have our peak formation high. That lower high is our peak formation high. And we'll just take a quick look at one level, 2 levels, and a third level of drop from that lower peak formation high, 50, 50, and 50. There's our low of the day, which they break out of in the London gap time. They break out of that lower level. Now, this is all prior to the New York Open and major red news. But look at the template. This is yet Friday's high. Friday's high becomes our new possible target if this sets up as a dump and pump type of template. So once the thesis is there, and New York Open, 9:30 a.m., we had major red news at 8:30 a.m., we can now go to work on the smaller time frame, knowing that there's going to be volatility at the open, but we have our thesis in place for the larger big picture. This is a 15-minute chart for the dump and pump scenario, even if it's just back to the high of the London session, but we have a larger template. Peter Brandt talks about the pattern within the pattern. That's our little rectangle at the bottom of the range. We have the top of Friday's peak formation high. We have day 3 breakouts that failed, but the market is auctioning down. It's come down 3 levels of drop from the high of the day. We've gone into consolidation at the low of the day. That consolidation is our pattern within the pattern. That's our rectangle. This is all prior to the New York Open. So on major red news, the market wicks back and forth. The second hour opens and breaks out of the high of the day. This is our 1 minute chart. The market goes vertical before engulfing. This higher high, 3 minutes into the New York Open. Think about what's happening. They hit stops. They trigger breakouts. First mouse is in at the open of the New York Open. First mouse is up 50 to 75 pips. As one trader said, he got stopped out. He was in at the open, and I said, rule number one, you're up 50 to 75 pips. Why did you not take profits? As Bill McLaren said to me, learn to take a profit. Higher high on the inside before the dump back into the first mouse. Pin hammer. 1 push, 2 push, 3 pushes. Guess how long this 3 push move took? 14 minutes after the New York Open. New 15-minute cycle is starting. We've already coiled inside of our universal EMA. We have a dump and pump setup on the smaller time frame coinciding with our larger template. Our larger template from Friday's high, the larger dump and pump template, our universal entry criteria. This coil now is what I will use for a potential range expansion, high to low, targeting back to the high of the day for either a trailer or taking profits or our timing window. We can narrow that into bodies, see if we get a full range expansion on this. But that explosive move was 50 pips in 5 minutes, a little bit more than 5 minutes, but continuation back through, didn't quite get to the overall high until later. If we back this up, we'll look. Dump and pump template. 3 levels of drop. US session. Asia. Lower low in the London gap time. Peak formation high, peak formation low. Explosive parabolic reversal. This is a template. A 2-day template. High of day. Drop at 3 levels. Go into consolidation. Trigger breakouts. Reverse the market. Looking at the S&P, I'm not going to spend too much more time on these charts. You guys can go back and look through your homework. The same setup. 3 levels of drop. 100, 100, 100. Consolidation. New timing window. 3 session reversal. Major red news. New York Open. Explosive parabolic reversal. Back to the high of Friday. Dump and pump template. NASDAQ 100, the same type of scenario. 3 levels of drop, 50, 50, and 50. Consolidation, higher high on the inside. The dump, consolidation, pump, higher high, New York Open. Dump, coil, explosive, continuation back to Friday's high of the day. Dump, consolidate, and pump. Clean, simple. The U.S. indexes were textbook opportunities today. British pound, Japanese yen, Friday's high, 3 levels of drop, 50, 50, and 50. And you'll notice peak formation high in Asia, starting our day off, peak formation low. Market made a lower high before breaking out and then took that high out. That higher high on the inside is our new reference point now for, you guessed it, a dump and pump template. And you'll also notice the London high dumps down from 75 to 50, 50 to 25, 25 to double zeros before consolidating in that lower 25 pip box. 3 pushes and reversing. Higher highs, higher lows heading into the open of our session. Major red news for a low-hanging fruit continuation trade on a first bar entry, either on the 5-minute or the first minute, whatever traders preferred. We'll look at that, but just again putting our universal EMA on there. Low-hanging fruit, 3 levels of drop, dump, and pump heading into our US session for 50, 75 pips, depending on where traders got in. Major red news, no wicks, so a clean opportunity underneath 25 for 75 pip move back through the high of the day. Low-hanging fruit trend continuation trade. So Stepping back and looking at the larger template is what's going to allow you to identify the best candidates, and not just trying to get into something at the high of the day or the low of the day, understanding the news calendar, understanding the types of behavior when news is released, having a thesis, having 3 or 4 instruments, and then knowing the timing. Index is open at 9:30. There are first hour opportunities on currencies, gold, and keeping it simple. Stepping back and allowing the best candidates to set up. For a Monday, this was an absolutely fantastic opportunity. Free Cash Mondays, traders. Tomorrow is day 2, Tuesday, in our Monday, Tuesday, Wednesday template. Depending on how things set up, we will look for the best opportunities and we'll execute them as follows. 3 session setups, traders, 1% better every single day. And may the markets go with you.